increasingly we're just seeing these concepts of awareness of environment, society, planet as just part of Finance 101. Who doesn't want companies that are efficient in their use of energy, their use of resources, that minimize waste? Because that's part of your finance returns. Social is then about things like staff turnover, absenteeism, reducing death and injury rates in your factories. That's your productivity. And then governance, well, we all pick your favorite governance disaster, but we know that damages your wealth. So while these are very much a framework for thinking about our impacts and our outcomes, it should just be integrated increasingly into the way that you think about doing the job.
And I think a lot of times everyone is looking for kind of that silver bullet. What is that one KPI that's going to tell me this company is going to outperform this company? And that can, I would say, I caution against a silver bullet. It's going to change from sector to sector and region to region. If we look at the revenues of a company increasing, and then we look at something like a carbon footprint, if that carbon footprint is increasing at the same rate or at an even steeper rate than the revenues, that represents to me an unsustainable business model for the future. And that's kind of really the signals that we're starting to look for, combining this extra financial data with the financial data.
I would expect investment managers to be taking ESG factors into account as a matter of normality in all funds, conventional funds, not just funds that badged ESG, because if you're not doing that, then you're not able to look at a company and work out if it's sustainable. I think that once you've done your financial analysis on the company and all the things that you should do to work out whether it's a financially viable company now, or appears to be, then the ESG analysis will allow you to understand where it's going to go in the future.
We just look at kind of the MSCI All-World Indice and take out the worst polluters in there and keep the indice balanced the exact same way, but then basically trade out on a sector basis companies with the worst carbon footprint. We actually were able to track the indice within 1% and reduce the amount of carbon footprint for the portfolio by 63%. So I think you can have a bigger impact than you realize and still track these portfolios. It just comes down to what is the impetus for you?
So instead of thinking about sustainability and things and ESG as removing negatives, think about it as actually looking at the world in the next 15 years as a set of fantastic growth opportunities of undiscounted, unrecognized, emerging growth opportunities. I want to find out what's going on in the future. And the other thing that we find that is important with active in this area in particular is long ownership periods. If I'm looking to be more impactful in the way that I invest to try and meet the SDGs, or the companies in which we invest meet the SDGs, then you're looking at a really 5 to 10 year time horizon where you're trying to be aligned with the capital allocation and growth prospects of the individual companies. My strapline is that sustainability is not an option, it's an imperative. And each of us has this complex series of impacts, both positive and negatives, as individuals, as companies, as investors.